Quint.
Hello and welcome to Bloomberg Quint. You're watching the fine print. Pre-election spending versus austerity, growth versus fiscal deficit, spurring investment versus revenue concerns. Finance Minister Arun Jaitley is faced with these options as he prepares to present the union budget on February 1st. The choices he makes will determine if investors find India competitive, if corporates can do business with ease, and if stressed assets in India can see resolution at the right cost. For all of this to happen, the Finance Minister's approach to tax will be key. We asked India Inc. its top 5 tax asks from Budget 2018.
15% in the UK, 21% in the US, 17% in Singapore, 20% in Vietnam and 25% in China. Among both developed and developing economies, India has one of the highest corporate tax rate of 30%. In 2015, Finance Minister Arun Jaitley had promised to cut corporate tax rate from 30% to 25% over the next 4 years. But it was only last year that he took a baby step towards this promise by reducing corporate tax rate for companies with less than 50 crore rupees turnover to 25%. So, this budget, will the Finance Minister deliver on his promise of reduced corporate tax rates?
Yeah, I think Honorable Finance Minister should now conform to the promise made or the budgetary proposals which were made in the first budget, because all the background work has already been done. The depreciation rates have been brought down, the investment allowances has been removed, the deductions, industrial deductions and income related deductions have been removed. So now this is a fit case that the corporate rates should come down, because that is how the entire package will be over.
Given that there is a new tax code which is being thought through, I think that should be more a function of the new tax code than anything that could be done on an ad hoc basis in this budget. Having said that, if there is scope to reduce the tax rate by 1 or 2 percentage points, I think going from 30% to 25% is unrealistic to expect. But if you were to go from 30 to 29 or 30 to 28%, that will go a long way in boosting sentiment.
My hunch is that you may see a across-the-board reduction insofar as manufacturing is concerned. And the reasons for that could be, number one, that manufacturing continues to be under some degree of strain. Manufacturing also continues to be an important area for employment generation. So the experiment that they had last year to look at companies below 50 crores turnover, you could see some element of change over there as well. Having said that, I certainly don't think that there would be an across-the-board reduction from the 30% tax rate, unless it could be percentage points here and there.
We'll know on February 1st if the Finance Minister lives up to his promise. The second ask of corporate India relates to the dividend distribution tax. Among the BRICS countries, India is the only one that imposes a tax on dividends. Experts say that DDT has served its purpose and India should move to the system of dividend taxation in the hands of shareholders.
Currently, dividend distribution tax is paid by a company on its distributed profits. The applicable rate is 15%, which effectively becomes 20% with surcharge and cess. Dividend distribution tax was first introduced in 1997 so that the tax administration doesn't have to deal with hard copy of TDS or tax deducted at source certificates. Since it is a single point of taxation, it also addressed concerns of revenue leakage. But experts say both these reasons don't exist anymore, with TDS system moving online and the tax department anyway getting details of income that attracts TDS.
Technically speaking, all the reasons behind introduction of DDT have already been sorted out by introduction of technology, including TDS matching, as you rightly said. But will it be done? I doubt, because only last year, the dividend in the hands of mega rich has already been taxed at the additional rate of 10%. So that equity has already been brought in, which was already, it was alleged that the rich are getting less taxed by way of dividend distribution tax. So that equity has already been brought in. So I don't think Honorable Finance Minister will dwell into this area at least.
So the dividend distribution tax in India is actually an additional tax on already taxed profits of the company. Basically, there are three levels of taxation which happen on dividends. First, the company pays tax on its profits before they are made available for distribution as dividend. And then you have a grossed up dividend distribution tax which the company pays. And then now in the last budget, there was a provision to tax dividends over 10 lakhs received by individuals. So that actually dividend gets taxed thrice. So I think from a rationalization point of view, it does make sense to to get away from dividend distribution tax, and that profit would still be taxed in the hands of the recipients.
Whether you are a foreign investor or you're a domestic investor, even if you enjoy the exemption on intercorporate dividends, your dividend distribution tax lends you to a very, very inefficient, uncreditable tax. Purely from a foreign investor standpoint, dividend distribution tax is not creditable. Last but not the least, you have now the US tax reforms, which has made repatriation of earnings in general very, very easy from a US tax standpoint. So you would have many US multinationals wanting to repatriate their earnings. I think all of this will, in my view, compel the government to review the dividend distribution tax regime, first thing, move on to dividend withholding tax, and second, have a moderate rate of dividend withholding tax.
Well, that's an idea that will be cheered both by domestic companies and foreign investors. The third contentious area is minimum alternate tax, or MAT. It was introduced to collect a minimum amount of tax from companies that paid high dividends but no tax on account of exemptions. But some of these exemptions linked to profits and investments have been phased out, but MAT has remained intact.
Not only that, it has seen a gradual increase from 7.5 to 21%. And it's not just the high rate minus exemptions that's proving to be cumbersome. Introduction of Indian accounting standards has compounded the problem. Last year, the Income Tax Act was amended to provide a framework for companies that had to comply with Ind AS. The phasing out of exemptions and computation complexity on account of Ind AS, experts say, make a good case for abolishing MAT and extending the alternate minimum tax to corporates.
So essentially, once Ind AS accounting standards were implemented, the government came out with ICDS and comparable standards for computing minimum alternate tax. Now, virtually the provisions in these, particularly in the transition year, have been quite complex, and it makes sense for them to rationalize the guidelines and make sure that minimum alternate tax is paid on the book profits, like it would be the case in the normal course, like alternate minimum tax for other class of assessees like firms and individuals. So I think the more simpler you make any legislation, you also remove the the litigation in that, and the tax administration becomes so much more simple, and compliance also improves.
Under the existing provisions of Act, which were there till last year, there used to be a book profit. You had to make certain adjustments which were very specific. Now, after Ind AS, a different set of adjustments have arisen, which lead to adjustments on other comprehensive income, certain incomes which later on may be credited or debited to P&L account. We are looking into future. And then not only that, in fact, the equity adjustments which are likely to introduced in the MAT, mean certain capital reserves, certain credited to capital accounts, if those adjustments are also required to be made, these are all notional incomes. And what the new MAT suggests, and after Ind AS, that those notional incomes also become taxable profits, which was never the intention of law. It was never the intention of income tax idea or ideology also.
Well, if you look at the revenue and the fiscal deficit considerations, I don't think that the government will take away MAT. To your point, insofar as the complexity of MAT computation is concerned, I entirely agree with you. I'm not a votary of the MAT provisions. I always felt that the MAT provisions made sense at a time when there was complete divergence of tax profits and book profits computation in an era when we had several tax holidays. I don't think that is true any longer. So I have never been a votary of the MAT provision, and I think in the current context where you have IFRS, you are achieving an element of consistency. And you know, there are many forms of businesses that have converted themselves from companies to limited liability partnerships, just because limited liability partnerships do not have a MAT provision. So there are ways and means taxpayers are trying to figure out how to circumvent the MAT provision. So my view is that though there is a good economic rationale that can be made out as to why MAT should be discontinued, but I think fiscal consideration will not force the government to take MAT away, because the government has been collecting fair degree of MAT. Having said that, I've always felt that MAT is nothing but collecting the taxes in advance, because at the end of the day, the government is creating a debt in its a liability in its balance sheet, because it has to give credit for all of these taxes at a later stage when taxable profits are generated.
Fairer rates, reduced litigation and ease of compliance. Compelling reasons probably to abolish MAT. Moving on. The fourth key change will result in successful resolution of stressed assets. I'm talking about the tax exemption for companies facing insolvency process. This year, at least 4 lakh crore worth of stressed assets will go through the resolution process. To attract bidders and to fetch the right value for these assets, experts say tax concessions are imperative.
Under the erstwhile Sikh Industrial Companies Act, Sikh industrial companies were exempted from minimum alternate tax or MAT liability. Accumulated loss and unabsorbed depreciation of the Sikh company were also allowed to be carried forward by the amalgamated company or set off against its profits. To be fair, the Finance Ministry has indicated through a media release that companies admitted for corporate insolvency will get some relief on the applicability of minimum alternate tax. But a careful reading of this media note issued earlier this month reveals that the entire book profit won't be MAT exempt. Only the amount of total loss brought forward, including unabsorbed depreciation, will be reduced from the book profit for the purposes of MAT levy. Experts say this is a half-hearted measure.
Let's go to history. I mean, the IBC, or the Insolvency and Bankruptcy Code, is a successor of SICA, Sikh Industries Companies Act, and there are certain exemptions which were already given the nuances of the Sikh industries, their balance sheets, their accumulated losses, that they were neither subject to MAT. Their losses were protected, even the shareholding is changed, and the company's board were allowed to grant certain more exemptions to these Sikh companies post their revival. Now, under IBC, all these exemptions are not available. So what is happening now, that as a stressed asset, once a new bidder steps in, there is a haircut which banks are going to take, and the remaining loan has to be written back. Unfortunately, that the loan which has been written back, which could not have been paid by the bankrupt company or the probable bankrupt company, now it becomes an income for it. Now the company itself is, the existence of the company itself is in question, and the existing law wants this loan write back to be considered as tax under normal provisions. Not only under normal provisions, even under MAT. Even if once they are escaped out of normal provisions, MAT sword is already hanging on them. Second, once the ownership of this private company changes, all these losses which they have accumulated over the period of time becomes zero. Third, there is a section called Section 56, under which if these companies are issuing fresh equity to the fresh bidders, those equities are under challenge, whether if they are issued at premium, there is a issue of taxability in the hands of the company, and if they are issued at face value, since the market value may be more or less, the probable shareholder has to pay tax on that. So in this entire restructuring, certain tax issues are coming, which are coming out of notional incomes. No real income is arising to anybody, any party, nor the lenders, nor the company under question, or the fresh bidders. But these taxes are sometime becoming more than the insolvency value, or the insolvency value, or the fresh bidding value for the fresh bidder. So these tax issues may make this entire IBC as a non-starter as such.
If the incoming investors in these stressed assets are assured that they won't be facing a potential tax liability, it may lead to better and fairer bidding price. The final change is one that no one is wishing for, and that's the long-term capital gains tax. Today, long-term capital gains for equity investment are tax exempt after 1 year. Reportedly, a proposal by the Bombay Stock Exchange mooting for long-term capital gains tax has rekindled the debate of bringing back this tax.
Budget 2004 abolished long-term capital gains tax on listed equities. Stock exchange transactions since then have been subject to securities transaction tax. Income tax data for the fiscal year 2014-15 shows that long-term capital gains across companies, firms and individuals amounted to 84,000 crore rupees. But this is likely to include long-term capital gains on equity and other asset classes such as real estate as well. Experts say taxing long-term capital gains may seem like a low-hanging fruit, but it won't be a prudent move.
Well, difficult to say whether it's likely or not, but I hope that it doesn't happen because the market sentiment has been so very, very strong in the last couple of years. You don't want to do anything which will impact the sentiment. By putting in a capital gains tax, you're not going to collect too much of revenue, but you will significantly impact sentiment. And by increasing that capital gains holding period from 1 year to whatever is being talked about in the market, 2 years or 3 years, again, there is no incremental or no significant increase in the tax collection that the government will have, but it will create, to my mind, a lot of negative sentiments in the economy. So I hope it is something which is not done.
So for the last couple of years, at least, every time the budget is, before pre-budget discussions, this point does come up. But I don't think it's a wise decision to bring in long-term capital gains on equity, because the basic idea was to improve or increase the investor participation, particularly at the retail level, which has happened because of this exemption for equity being traded through the stock exchanges and being held for more than 1 year. I think, and again, it's not free. Basically, both the buyer and the seller pays security transaction tax, though it's a small percentage, but it's on the transaction value and not only on the capital gains that the person or the investor has made. So I think the current regime as it stands is quite reasonable. Any attempt to bring in LTCG will be a disincentive and would impact the kind of market movement that we are seeing and the investor participation. And people who have kind of readdressed or rearranged their portfolios to have a mix of equity and other typical instruments would again go for other investment classes, and I think it will not be good for the equity markets.
There was often a criticism until last year that there is a compelling case that is made out for charging tax because of level playing field, because we had FPIs virtually getting no tax on capital gains. Well, I think to a larger extent that level playing field is no longer a valid argument, because last 18 months the government amended the treaties with Mauritius, Singapore and Cyprus. We are going through a transitioning 2-year period. Starting April 1, 2019, which is just a year away, that level playing field argument is no longer valid. So I would rather prefer that the capital gains regime continue. If for any reason the government in its wisdom decides to levy any form of tax on capital gains which is more onerous than what it is today, then it is a compelling case for us to take away the securities transaction tax, because the securities transaction tax clearly is in lieu of the exemption that was granted for long-term capital gains and the reduction in rate that we saw on short-term capital gains to 15%.
Well, these were the top 5 tax asks of India Inc. We'll know on February 1st if some of these, most of these or none of these make it to the finance bill. Stay tuned to the Fine Print. Thanks so much for watching. We'll see you next week.
Where there is life,